Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in from today. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's hot sheet, I will discuss February's core PCE index, jobless claims, rent growth, and Realtor.com's monthly market report. Today is Friday, March 31, 2023. I am Byron Lazine, and the hot sheet starts now. Here we go. Friday. Happy Friday for everybody. And it's been a wild week. When I started the week, I'm like, okay, this is going to be maybe a slower data week for the hot sheet. Nope. It was action packed, of course. And we've had so much to go over. Just one of the more wild weeks in recent memory. And that's saying a lot here as we close out quarter one of 2023. Quarter one was certainly interesting, as was yesterday's hot sheet, which I encourage you, if you missed watching or listening to yesterday's hot sheet, Thursday, March 30th, go back and take a listen after this one. I do want to update real quick before we get into our discussion today, our main topic yesterday, which was the class action lawsuit status that has now been granted on the Morel versus NAR et al. Case. My good friend Mark Davison, founder of 1000 Watt, the premier branding agency in real estate, sent me over a couple survey questions that they had taken. This is a national survey, and I think the data is enlightening, so I want to read this to you guys before we get started. When you bought your, this is to consumers, okay? So when you bought your house, did you understand how your buyer agents were compensated? Okay. When you bought your house, did you understand how your buyer agent was compensated? Okay. 46.17% said yes, they understood it clearly. And yes, I had a general idea, 32% plus. Okay. So it was unclear to me, was almost 13%, or I had no idea, was 9%. Okay. So 2 out of 10 buyers are saying unclear or no idea, area for improvement there. But generally speaking, general idea, 8 out of 10 had an idea. 1 out of 2 understood it clearly. Okay. 1 out of 2 understanding it clearly, agents, huge area for improvement there. Again, if you're unfamiliar with what I'm talking about, this class action lawsuit, we went into detail yesterday on that. Definitely go back and watch it. I just want to bring to attention this other question that Mark shared with me. And thank you, Mark, for doing so. Do you think your agent got paid too much in this scenario? Interesting here. No, not at all, was 27%, 27 and change. No, not really, 44.9%. Okay, good. Now, yes, probably, and yes, definitely for did your agent get paid too much in this scenario? Talking about the buyer agent here. Yes, probably was 22.6%. Yes, definitely was about 5%. So 1 out of 4 buyers were like, yeah, probably or definitely paid too much in the scenario. Big area for improvement there. 2 out of 10 don't have a general or clear understanding of how buyer agents are being paid. And then 1 out of 4 believe overpaid. So big area for clarification, for showcasing value, for being up on this show every single day, whether you're listening to it on the replay or whether you're consuming it live. Appreciate all you guys consuming it live. Love for you to hit the thumbs up and consider sharing it with someone who can benefit. Let's jump right into the news of the morning, which was the Fed favored. I don't want to know any Fed flavors, but the Fed favored inflation gauge rises by less than forecast. Spending moderates. Good news, good news. Okay, I'm reading off of Bloomberg. Core PCE index jumped 0.3% last month, and January was revised down. Okay, so why was the core PCE index climbing 0.3% for the last month? Good news, well, because it beat expectations. The expectations were it was going to come in at 0.4%. Excluding food and energy, the Fed's preferred inflation gauge, the personal consumption expenditure price index, rose this 0.3% in February after the prior month was revised down slightly. The overall PCE climbed by the same amount, Commerce Department data showed Friday. Okay, consumer spending adjusted for prices fell 0.1% after surging upwardly, an upwardly revised 1.5% at the start of the year. The decrease reflected a drop in outlays for both goods and services. The PCE price index was up 5% from a year earlier, a deceleration from January, and far higher than the central bank's 2% goal. Okay, but 5% to 2%. We're getting closer here to the FOMC's goal of 2%. Excluding food and energy, the core PCE price index climbed 4.6%, matching the smallest increase since October 2021. There we go. Bobby, I need one of those clap buttons here. I'm pressing my switcher. Nothing's happening. Big round of applause button there on the since 2021 U.S. stock futures. I think I'm just telling jokes to myself right now, so that's okay. U.S. stock futures rose. Treasury yields plunged as traders wagered the Fed would be done hiking rates soon. Okay, it doesn't sound like that's necessarily the case after the last couple of weeks, which we've covered here. The core PCE measure came in slightly below the median estimate of 0.4%, a Bloomberg survey of economists show. Okay, I've got a little chart from Bloomberg here that I'm sharing with you guys. It's down below in the daily download link, as well as all of our sources and links to every single source that we talk about here today and every day. Underlying inflation cooled in February. U.S. real personal spending softened after surging at the start of the year. So you do see here where we're starting to recede just a little bit. It's a slow trickle. It's painful to watch at times, but it is happening, this deceleration of inflation. And again, this gain matched the smallest since October 2021. Very good news as the Fed is watching this closely. And again, this was the Fed favorite. Bobby, look, Bobby go. Working hard on a Friday morning, getting the clap. Maybe I don't know if that's too psychotic to start mixing in to the hot sheet, but maybe we'll roll it out every once in a while. Okay, we've got an update yesterday that I forgot to mention at the end of the show. It kind of came out right before the show on jobless claims. Jobless claims edge up to 198,000, which is higher than expected. So it's the first week in recent memory where we saw jobless claims actually go higher than expectations. Remember, Jay Powell, he wants people to lose their jobs. He wants good, hard American folks to lose their jobs. So this going higher than expectations is actually good in the Fed's eyes. They want to see that. They want to break the job market like they broke the housing market. Jobless claims for the week ended March 25th totaled 198,000, which is up 7,000 from the previous period and a bit higher than the 195,000 estimate. Still well off from making a significant dent in this extremely, strong, viable job market. I'll take this comment here. Could the mortgage rate strategy set the stage for future refinancing, which is profitable for mortgage companies? Absolutely not. 99% of just my take, 99%. I think if you're doing a refinance, you really need it. 99% of homeowners right now have a rate under what it is today. Okay. So, and most are like in that under 4% range. So, I don't see refinances making a comeback anytime soon. And the data's been clear on that. We're way down on refis. It would take us getting 5 or under for refis really to pick up in any significant way. My thoughts. Continuing claims, which run a week behind, edged up 4,000 to 1.689 million. And I don't know if you're relating that to the job. So if I misunderstood, Ruthie, please clarify if you're thinking job losses would maybe create refis where they're in a position back to the wall refi. I guess you would look at it that way. The final GDP reading for the fourth quarter of 2022 showed the economy grew at 2.6% annualized rate in the fourth quarter. That number, I believe we've already been discussing here. Okay, so continuing claims, which run a week behind, edged up 4,000 to 1.689 million. This was below the FactSet estimate for 1.6935. Okay, so jobs, generally speaking, continue to be incredibly strong. First week that we have seen jobless claims be higher than expected in quite some time. And we'll continue to monitor that. The Fed wants to see this number go up, I think, even to like the 300,000s per week. Thank you, Dawn. Appreciate you. Appreciate you tuning into the hot sheet. Appreciate all you guys. Hope everybody is going to have a fantastic Friday. Hit the thumbs up if you're feeling it. Okay, rent growth drops back to pre-pandemic levels, but some markets are falling much harder. Okay, this is really good sign for how the Fed's going to be looking at inflation. If we can get rent growth to drop off significantly, we know we've got data coming in May where a lot of this high shelter lagging data can get pulled out of inflation, right? This would be a very good sign for stopping interest rate hikes. Apartment rents have increased slightly for the past few months as the seasonally stronger spring activity kicks in, but in March, they were only up 2.6% from a year earlier. This is the smallest gain since April 2021. So on core PCE, we get the best news we've had since October 2021. And on rental gains, we get the best news that we've had since April 2021. Bobby, if you've got your little claps, or I don't know if that was you clapping or noise. All right, that would be enough. That is never going to happen again. I promise you guys on the hot sheet. I'm officially canceling that. That is definitely psychotic now that I've heard it the second time. After last year's record-setting pace, rent growth is now slightly below the pre-pandemic average of 2.8%. Apartment rents have increased just slightly here, and they're only up 2.6 from March 2002. This was from Apartment List, okay? Smallest annual gain since that April 2021. Some markets, such as San Francisco, are falling at a bigger rate, okay? I know we're not going to get to it today, the commercial real estate discussion, which San Francisco is getting hit really hard there. We're going to roll that over into Monday. Still want to talk about that. It's just been such a wild, jam-packed week here on the hot sheet. Vacancies are also starting to rise back to normal levels. This is residential rents, of course, as more supply comes on the market. This is what I've been talking about all of quarter one here. Vacancies, as they start to rise, which they're rising right now, okay, back to normal levels, and maybe even we get them beyond normal levels because more supply is coming onto the market. Remember, the last 3-4 years, it was advantageous for investors to go out there and build multifamily apartments, and a lot of that inventory, these multifamily buildings that have been built up the last couple of years, are hitting the market in Q3 and Q4 to consumers, to people who need an apartment to rent. And so as more supply dumps onto the market in apartments, that will create more vacancies. If I'm living in a place that's not brand new and I got a brand new place across the street with amenities and my lease is up and it's dollar for dollar similar, I'm going across the street to the amenities. I want the new hot tubby, okay? There's nothing better than a brand new hot tubby that the public hasn't destroyed yet. I'm going over there. Now, more vacancies is going to create those guy across the street to lower the prices. This is going to be really good for inflation measurements. We know this is kind of baked into the cake with supply on multifamily, but it's taking a while to catch up. And we know that, listen, rent numbers make up the largest portion of inflation. And so as these kind of get pulled out, we may be in a position where the Fed's all of a sudden, oh my gosh, we got to cut because look at these numbers got sucked out of inflation all of a sudden. Okay, so vacancies, they stand at 6.6%, up from 6.4% in February. Still very low, but getting back to normal levels. Over 917,000 apartment units were under construction. This is what I've been harping on across the U.S. at the end of last year, which will increase the nation's existing apartment base by 4.9%, according to RealPage Market Analytics. Imagine if we had 917,000 affordable homes hitting the market, single family homes. That would be pretty cool. That'd be pretty significant. It's the highest number of units under construction since the early 1970s. The U.S. government has made it really easy for people to build apartments. They've oftentimes incentivized it because they believe they're helping affordable housing by creating more apartments. I would disagree. I think they're ruining the future of a lot of American families by keeping them into a rental situation, a renter nation. And I want to see more. And we've got a story that I'll cover on Monday. I want to see more government officials go out there and try to, create opportunities for affordable housing where you can own, where the people living there can own and have that equity. We know that the average homeowner is 44x more wealthy than the average renter. There's not too many surprises there of why. Markets seeing the biggest rent jumps compared with a year ago were mostly in the Midwest, with Chicago, Indianapolis, Cincinnati, and Louisville, all up 6%. Boston rents rounded out the top 5, also up 6%. Several major cities are seeing these declines. Phoenix, Las Vegas rents were down 3% year over year, and San Francisco dropped 1%. Rents for single family homes are also easing, okay, but are still far hotter than apartment rents, okay. Single family rent growth was 5.7% year over year in January, lowest rate of appreciation since 2021, according to CoreLogic. So big theme today, best number since 2021, best number since 2021. These are this is a way to end a week that has been a little bit bumpy, and way to end a quarter one that has certainly been a little crazy. Of the 20 markets tracked by CoreLogic, Orlando had the highest rent gain at 8.9%. Also, Orlando, Disney's doing, I retweeted Danielle Hale from, by the way, follow me on Twitter if you want some real-time discussion. I'm doing a lot of it there. I'm sorry, I was getting her confused. Daryl Fairweather from, I don't want to get her confused. Yeah, Redfin, I thought so. Okay. There's Disney's putting 1,300 affordable housing units in Florida. I think I'll touch on that when I talk about the other affordable housing news in Florida that came out yesterday as well, when I discussed that on Monday. But 1,300 units, what I'm hoping, because I haven't been able to study that in its entirety yet, what I'm hoping is they'll let their employees own there, as opposed to just like rent. If you're renting where you work, that sounds like we're, really controlling them. So anyways, we'll dig into that on Monday. Miami was seeing 39% annual growth last January, but that's down about 7% this year. So Miami's still extremely hot. You wouldn't want to touch that pan right now. And let's switch over to single family homes and go to the realtor.com report that just came out this week. March 2023 monthly housing market trends report. The number of homes for sale increased by 59.9% compared to last year. Of course, this is according to realtor.com. So we've dug deep into NAR's numbers here this week, and this is realtor.com's. Okay, the total number of unsold homes, including homes that are under contract, increased by 9.3% compared to last year. Home sellers were less active this March. So let me know in the comments if we need more home sellers in the market in which you serve, with 20.1% fewer homes being listed for sale compared to last year. All right, let's take a look at all of the data. All of this will be available for you in the daily download below. So grab this and use this. Certainly, if you're an agent, working with agents, or working with the community, this is going to be very important for you. Active listing count up to 59.9% year over year in March 2023. The March number you can see down here if you're watching on the left, okay, up 59.9% year over year, but well below 2020 active listing count, 2019, 2018, 2017. It's not even close, right? We were at 562,565 active listings for March 2023, which is, we're closer to 1 million in 2020. We're between 900,000 and 1 million. We were over 1 million in 2017, 18, and 19. So still near very much historic lows of the last couple years. Total listing count is up 9.3% year over year in March 2023, which, believe it or not, is below 2021. Just above last year, 9.3%. So still, as you can see, based off of 2020, going back to 2017 numbers, well below total listing count, with no signs here yet that we're going to spike up. Look at the, it should happen, I guess, in April, based off of the last 2 years. This is when we theoretically should see a jump up, but we still got to jump quite a ways up just to get to last year's levels. And we'll see what happens here as we move throughout the spring and into the summer. Pending listing count is down 24.5% year over year in March 2023. The report that just came out from NAR is pretty close to that. I think it was 22% when we covered it earlier in the week. I'll pull it up right now just to do a quick comparison. I believe it's pretty close though, so I don't know. Obviously, NAR ends in their data in February. So this data here is it's released in March, but I don't know if it's ending in February. Let me actually I'll take a look at that as well. Yeah, 21.1%. According to the pending home sales index, PHSI, that we covered this week here on the hot sheet, dropped by 21.1%. Okay. That was as of the end of February. Okay. According to NAR. Now, according to Realtor, we're down 24.5% on pending listing count. I would know that, listen, there's so much crap in mainstream media right now. Obviously, if you're paying any attention, you know what I'm talking about. All these different headlines that our consumers, whether you're an attorney, whether you're a lender, whether you're an agent, that our consumers are seeing those. So, fifth page in or 10th article down might be a housing headline, and they're probably just headline reading. And so they're going to see pending listing count down 24.5%, or they're going to see the NAR number down 21.1%. We should know roughly we're between 20 and 25% down nationally on this pending listing count. And then we should know for sure what our market reads. Okay. And then we should be able to help them understand that headline that they're seeing, because they may say down, pending listings down, and just say market down, prices down, right? It can be very confusing for consumers when they see these mainstream media headlines that are mixed in with a whole bunch of some housing and some other crap there. Okay, so when Realtor.com says their March housing data, it's not saying it's till the end of February, but it came out on March 30th. So, yeah, this is the month of March. They put it out on March 30th, so they ignore the last 2 days, apparently. This is for the month of March. So when they go year over year, they're going till, I would assume March 29th, March 30th. Interesting that they're not waiting for March to close out. So this Realtor.com data is a little bit more real time than NAR. By the way, I got into a back and forth with an agent. I think I shared that yesterday, and it continued. Or the back and forth, I guess, started yesterday after the show, where this agent was like sticking up for NAR having old data. I'm like, if NAR just watched the hot sheet, they would know what the 30-year fixed is. It's not my fault that they timestamped it. You can go look at that thread on my Twitter. Sorry to completely divert there. Back to this, the pending listing count. So this is through March, I guess 30th here for Realtor.com. A little bit more of accurate data. And so this tells me that in 1 month, when NAR comes out with their pending listing count going all the way till the end of March, that we might see this number decline even more from their 21.1%. Okay. Something to watch there. I'm gonna take a note of that. And I'm in a month here when NAR updates us on March. We'll take a look at that. And if that's the case, then it would tell us that realtor.com is where we want to follow. Newly listing homes down 21.1% year over year in March 2023. Newly listed homes below 22, 21, 20, 19, 18, and 17 levels. Just shockingly low. And the incentive for the sellers is, why do I want to, Ruthie, to the conversation earlier here, why do I want to put my home on the market? I don't want to refi it. I don't want to sell it. I want to keep this 3% interest rate. It's like printing money right now. Days on market, time on market was 18 days more than last March. Okay, so the inventory that we do have is starting to tick up a little bit, still well below 2020 to going back to 2017 levels on days on market. Median list price higher than 2022 or any year prior going back to 2017, 424,495 for March. It's up 6.3% year over year on the median list price, according to realtor.com. A couple other ways to look at this. Lance Lambert, when this information came out here, put together a couple of charts himself for Lance Lambert from Fortune. And I'll share those with you guys. Again, all these charts are available down below in the daily download link, where you can get all of the sourced articles as well as these charts. The mortgage rate shock saw homes hit the market longer, but days on market remain below pre-pandemic levels. Okay, so shows here a little bit easier to understand, I guess, the way he's putting it together, these pre-pandemic levels and where we're at today on days on market. And then inventory has recovered from pandemic lows, but remains well below pre-pandemic levels. So again, look at that. That one is eye-opening there as I draw the line across the screen. 562,000 on the national active listing count for the month of March in comparison to 934,000 in February 2020, 1.1 million March 2019, 1.1 million March 2018, 1.2 million March 2017. Crazy there to see that. And then we have this one here. There isn't much new inventory coming on the market. Of course, the 349,000 new listings in March were lower than the 437,000 last March. And if we go back to 2017 and 2018, we're up over 500,000 for those months. So new listings is what we desperately need. And what we'll continue to take is some more of this good news that we talked about today. Core PCE, good news there, as well as the rent growth was also good news. If you missed some of these hot sheets this week, they were action packed. I would encourage you to go back over the weekend in the gym, on a walk, on car rides to open houses, whatever it may be, to give it a listen. The show's obviously available here on YouTube. Hopefully you have subscribed already, and please subscribe if you haven't done so. It's also available on wherever you listen, Spotify or Apple, if that's easier for you. You will miss on Apple the visuals with the charts. All of these charts can be very useful to you when you're building your business and creating opportunities to market yourself and build your brand. It's why you need the new BAM ebook, Mastering the Green Screen. In this ebook, we dive into how to use green screen mode with confidence so you can create amazing videos that captivate your audience. Today, there's 10 downloads below in the daily download link with all of these charts. You could have 10 green screen videos. Green screens are still providing the best organic push on Instagram and TikTok right now, green screens and carousels as well. You could use this ebook to help with your green screens to master that technique. That download is below, and the ebook is completely free. What is not free is the 10-year treasury yield. 10-year treasury yield is at 5.8%. I'm sorry, 3.525, 5 point something would have been insane. It is down a tick. Finally, the first time all week, we've seen it come down a tick, 3.525. And so hopefully we'll see some relief on the 30-year fix, which has been NAR research. In case you're listening, it has been over 6.5 all week, not under, as stated on Twitter with a timestamp of March 29th. It is at 6.54 on Monday, 6.6 on Tuesday, 6.61 Thursday. Yesterday came down a tick to 6.59. Hopefully we'll get closer to 6.5 today. But so far, looking at the 10-year, as we follow it every day here on the hot sheet, it doesn't look like we'll likely get under 6.5 to end the week. Okay. If I'm talking to a consumer, if I'm talking to a buyer and I'm telling them on March 29th that we're under 6.5 because last week's headline said that we were, and then they go to lock and it's March 29th and it's the highest day of rates for the week at 6.61, they're going to be looking for a new agent. This guy doesn't know what he's talking about. Okay. Historically, interest rates haven't shifted this much day to day. We're not in those days anymore. Okay. That the 2017 playbook does not work in 2023. 2023, you better know your stuff day to day. And it's why we do this show every single day. So thank you for being a part of it and have enjoyed this week. I hope everybody has a great Friday. I'll see you back here Monday, 9:30 a.m. Eastern, 6:30 a.m. Pacific time. And until then, toodaloo.